Money Effect, where I bring you all news, money, and finance related. Disclaimer: this is not financial advice and strictly for educational purposes, and it's just my opinions. Please hit the like and subscribe if you like the video for the YouTube algo and continued content. Now that's out the way, let's go. So, the topic I want to talk about this week is surprise, surprise. A lot of surprises out there. So, the Bank of England has increased interest rates, becoming, one of becoming the first, big rich economy in a sense. The EU and America. There's been other countries that have done it, but in terms of, one of the big boys, they're the first to do it. Now, one theme we've had and we've discussed on this channel is inflation. Inflation has been rampantly out of control. The latest CPI figures, I think we're like 5 point something percent now. We've discussed food prices rising, energy prices rising. Petrol is going up. Everything is going up. But these highly educated officials from the Federal Reserve to the Bank of England to the European Central Bank have all said, it's just temporary, it's just transitionary. I don't know how many words, if I do a pseudo, I'm not sure how many words you can um, say for temporary, but we've had all transitionary, it's not permanent, we've had it all. The inflation will be all right. It's just supply side shocks. Once supply starts coming back to the market, we will naturally see inflation go down. Well, the Bank of England has said, you know what, we're not convinced by that anymore. Inflation is getting too out of control. We need to act now as opposed to acting next year. And in one hand, you could say congratulate them because potentially now the rate rises will be gradual, whereas the Federal Reserve hasn't yet moved. And maybe they'll have to be more aggressive, which will have more repercussions. But yeah, they've rose it, and you know it's gone from 0.1% to 0.25%. Now, one of the hesitancies was with the new variant. A lot of people were thinking, is this kind of the right time for them to make this move? Because if we're going back into potential, we've seen more travel restrictions, etc. If demand is easing off, and now you're adding an interest rate increase to it, demand might even ease off even more, and we do not want to get into a place of the opposite of inflation, which is deflation. So maybe the timing, people are questioning the timing. Maybe last month, when we were getting those high CPI figures, maybe wait another month, see how this variant plays out. But no, the Bank of England, unlike the Federal Reserve and the European Central Bank, have decided, you know what, we're not playing around. This inflation is not transitionary. We need to tackle it. We're raising rates. And of course, the pace of the rates, most people, since the financial crisis in 2008, we've been in a low interest rate environment. We haven't gone up. I don't think we've gone higher than more than 1%. So a lot of people have been accustomed to low borrowing. Now, if this is a sign of things to come, and next year we're going to start aggressively raising rates, we really need to start thinking about a lot of things. So, in this video, we just want to discuss. It's good the Bank of England are raising rates, but they're just going to raise rates, and they're not really going to tell you anything about anything else. This is like, okay, we've rose rates. That's nice. Like, what should we be doing? They're not going to tell you that. I'm here to try and help you. Now, one thing I would say is that already when the Bank of England raises rates, you might say, well, that's got nothing to do with me because I've got a credit card, I've got a loan, but that doesn't. They're not raising. Well, everything is linked to this Bank of England rate rise. This is the base rate. It's the minimum. Your bank that has a loan borrows from the Bank of England, and then they charge you an interest rate based on what they're getting from the Bank of England, and they add their little percentage on top, their little drink on top, should we say. Now, if they're getting higher costs from the Bank of England, they're not going to say, "Oh, well, we're going to absorb those costs." That's not the way the economy and the Western society works. They're going to pass those costs straight onto you, and it's going to be more than less immediate. Now, you've seen here already, HMRC late payment interest rate is going to be revised. This is like 3 days ago, literally a day later, like 27th of December, literally coming into effect this year. So you really need to, take stock of what you're doing. So the first thing I would say is interest rates increase, it's going to increase your borrowing costs. Now, with rising food prices, energy prices, petrol, we're getting a new tax next year, this NHS 1.25% tax. Again, apparently wages are going up. If you're somebody that you haven't really seen a tremendous wage increase, or it's just going up under inflation, you might differ and maybe send Boris, an email, or I don't know how you get in contact with politicians these days and say, well, you're saying wages are going up, but mine's not going up. And if you're in that case, then you're really going to be hitting it now, because now you've got the added expenditure of increasing debt. And if you're somebody that doesn't have debt, then fair enough. We'll discuss what kind of debts. But if you're somebody that doesn't have a mortgage, if you're somebody that doesn't have credit cards, if you're somebody that doesn't have loans, if you're somebody that doesn't have HPI on your cars, there's not even HPI now. There's another one now, whatever they call it. If you're not in that position and you're just living cash rich, then maybe the debt side won't even affect you, but then the savings side will. But I personally think this is going to affect everybody on some kind of level, and we need to kind of look how can we negate this. Now, in January, everybody writes their their New Year's resolutions, what they're going to do in the New Year's. Everybody tends to have a lot of holiday this time. Things are well, depending on what job you're doing. Obviously, maybe not the NHS, but things are fairly relaxed in work environments. So now is a good time to kind of take stock. And one of the things you can add to your New Year's resolution is organizing your debt. Write a list of what kind of debt you've got and how it's going to be impacted, and have you got expenditure to cover this debt? And it's going to be important, because yes, it's only a 0.15% increase, but if you've got large amount of debts, particularly a mortgage, which we'll come on to, it's really going to affect you. So start with the expensive things first, and then work your way down and see, let's start budgeting and calculating our debt and look at potential solutions. We've discussed about locking in those 0% balance transfers on credit cards, using your potentially 0% on your interest rate to start, if you can start paying off some of that debt, because this interest rate is only going to just increase going on next year, unless it's like you're going to have it either which way. If this variant takes hold and we go back into lockdowns, then yeah, then the interest rates won't increase, but then we're going to be back in lockdown, so that's going to affect you anyway. If this variant is not as bad as it is and the economy keeps on going as it is, then these rate rises are just going to keep on going up. So either which way, you're stuck between a rock and a hard place. So let's start organizing our debt now. So one debt, which I guess most people is the biggest one, not that most people will be on it, particularly first time buyers, is going to be your mortgage. And there's an article here from the Financial Times. The UK mortgage market is braced for a surge ahead of further rate rises. So obviously, look, people that have mortgages are doing inquiries and then looking at borrowing. Now, who would this mostly affect? Now, if you're on a variable rate mortgage, it's going to affect you. Now, variable rate mortgage is basically a mortgage that moves in line with whatever the Bank of England base rate is. So if the Bank of England increases their rate, your variable mortgage goes higher. If the Bank of England lowers their rate, your mortgage goes lower. Now, a lot of people are going to say, why would you want a mortgage like that? Because in normal times, you could benefit potentially if the rate was at a much higher level. Maybe it's only ever going to go down, so you wouldn't want to fix it. So you kind of have to look at your rate and see how you're going to impact it. Now, I think on average, for every 100,000, your mortgage might go up by like £8 or £10. Now that might not seem like a lot, but when you're adding that up month by month, and you're adding all the other things we've discussed about, increase, we've got a new tax, all the increases in cost that we're seeing, that £8 a month can actually add up now. So if you're somebody that is on a variable mortgage, now is the time to, start making inquiries with your brokers and think about remortgaging or moving on to a fixed mortgage. And like I said, a fixed mortgage is exactly like it says on the tin. You lock in a value. especially now when you know rates are going to go up. You lock in that value. Obviously, the longer you can lock in that value, the better. But even if it's a short term, you lock in that value and you know you've got your costs. Now, even if you're in a fixed rate mortgage, because I think most of the new mortgages that are given out these days, where interest rates are at such low levels, people are just going to get fixed rates because there's only if interest rates are such low level, there's only really one way they're going, and that's up. So a lot of people are on fixed rates, but maybe your fixed rate is coming to an end. So again, just go to your brokers, see what they can do for you, and if they can save you money. Now, you know, if you're locking in a fixed rate deal, if you're coming from a variable or you're moving to your fixed rate is ending, potentially you could be saving it on average 2,000 a year. Again, all these figures are subjective to how much mortgage you have, blah blah blah. But this is on average. So 2,000 a year, that's a holiday. So well, obviously depending on where you're going on holiday, but a nice holiday to Portugal, Spain, definitely can take the family there for 2,000 a year. So definitely something to look into and start, speak to your brokers and get ahead because probably they're going to be, especially now with this new variant, everyone's probably going to be off sick. So try and book your appointments now. If an appointment is taking weeks to come, so just call them, get an appointment now, and discuss your options because definitely something you're going to need to do at the moment. And like I said, we're gonna discuss one thing. We'll just say is that when the Bank of England raises interest rates, these are gonna go to you straight away. They're not gonna wait. These banks are not gonna wait. Like we've seen already here now. Look, under review, under review. That's nice. Two banks, but everyone else, they're jumping. These are the tracker mortgages, so they're like variable mortgages, but they're jumping. You see, all these banks. They're jumping, they're jumping, they're jumping. They're not waiting. They're not gonna wait and say, oh, you know what? Let's give these guys uh, 1 or 2 months to get used to before we. No, next day when their costs go up, your costs go up. That's how it works. These banks are not thinking, oh well, we're borrowing higher from the Bank of England, but we've been making so much money off our customers. We'll give them a 6 month. No, 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 no. The next day, your when their costs go up, your costs go up. So mortgage is going to be for those. It's going to be the biggest debt that most people have, assuming they have a mortgage. Definitely be the biggest debt you have, and it's the same principle goes to loans, credit cards. Everything's going to go up. And if you're barely on the breadline of you just managing your payments, and now you're going to have to deal with higher taxes and all these higher prices, it's imperative that you look at that, speak to your broker, speak to your bank, and try and see how you can lock in the price now because interest rates. Listen, I want interest rates to go up because that means we're not in another lockdown. So they're going up, hopefully, which means we're not in another lockdown. Hopefully they don't go up too aggressive, but we never know. And as we've seen, the Bank of England, all these people, they're just like you and me. They're human beings. They make mistakes. They get things right. Blah blah blah. Clearly, this inflation is taking. I've been saying it for months now that this is going to happen, but they're taking it. This is a shock to their system. So we don't know what might happen next month. They might think, wow, inflation is even more rampant than we thought and start making big increases. They might say, you know what, we made the increase and it was too big. With the new variant now, demand is leveled off. We might need to lower it or keep it. You don't know what they're going to do. So the only thing you can do is start organizing yourself and fixing. Now, another thing is savers. Now, if you're a saver, obviously the saving rates these days have not been great. You're locking in. Um, I don't even know what are the savings rates now. Like you're locking in, let's see, 1.61%, 1.39. So obviously they're not great as it is, and but with interest rate rises, these savings rates will get better. Well, actually, they won't. And that kind of just says how the way the world works and these banks work. They're very quick to pass on a rate rise to you when it comes to debts and lending you money. But in terms of you saving with them, they're not going to pass on this to you. Let's look already now. This is a perfect example. Look at all these saving deals. How the saving rates might change under review, under review, under review, under. So they haven't announced waiting to hear under review. I think it's only Santander that have said they're going to increase it by the bank. Everyone else under review. Tesco Bank, they're going to increase their interest, the savings on their bank. Everybody else. So that's two banks basically out of how many? But yet, when it came to an interest rate increase, look how many of them was doing it. All of them, mostly. So that just says everything. So if you're somebody that's a saver and thinking, you know what, it's time now to be shopping around for saving deals, I'd prioritize your debts at this point, locking those fixed prices in, and literally, interest rates are going to potentially keep increasing. So just wait till a better deal comes around, because there's no point switching now, because not only are they not even going to be um, set, transferred to these variable savings accounts, likely interest rates are going to go up anyway. So you might as well just wait till there's better deals. And if you're in a fixed saving rate, if you're somebody that is locked in, you have a 2-year fixed rate with Zupa, for example. Again, there's no point thinking, oh, let me. It's only been 1 year. Let me break out of that contract and get it. No, because likely the penalties you're going to get for breaking those terms is going to be way more than what you're going to get in savings from switching. Because these costs, like I said, are not passing right. Recently the Bank of England did a stress test on all these banks. And a stress test is basically stress. So in the word of stress we know is when you're under pressure, you feel stress. And that's the same principle here that Bank of England will apply. They will, since the 2008 financial crisis, when a lot of these banks didn't have good liquidity. When I say liquidity, I mean cash. So basically the bank itself, and I don't want to get into the technicalities, but the bank itself didn't hold enough cash to pay its obligations. So that's why we had all these mass bailouts, RBS, Lloyds, etc. Since then, the Bank of England has been very stringent and making sure that all these banks are highly capitalized. When we say highly capitalized, that means they have enough cash to meet their debts. So their equity is higher than their debts. Their cash assets is higher than their debts. So that's what we mean. And the Bank of England has done a stress test and found that if the worst was to occur, similar to 2008 financial crisis, most of these banks are in a way better position, and most of them, without any kind of intervention from the Bank of England or this quantitative easing, will be able to survive. Yet, even though these banks are so well capitalized, they're not passing on these interest rates to savers. But yet, they will pass on the increased costs to the people holding debt. So that's just the way, unfortunately, um, the capitalism and economics work. So you have to be wary of that. So prioritize your debts at the moment. Do not think savings. Yeah, you can shop around, but debts, 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 debts. Have that in your head at the moment. Now, what else could you potentially do? Now, we won't go too high on it, but another reason to not prioritize the savings at the moment is because, inflation, CPI, which is a measure of inflation, one measure. To me, it's not the real measure because it excludes some stuff. But we just say, for a point of argument, it is, because that's what they're using, is around 4.6%, 5%. CPI 5.1%. You can see it here. Now, if you take into account that you say basically inflation is your cost, so you're paying 5.1%, and you have fixed it, locked in the best deal you could possibly get, which is 1.61%. Now, we won't do too hard on maths, but that is about 3.5% difference. That's a negative difference. That means the real rate is minus 3.5%. So that means you are actually losing every time your money is in the bank, you are losing 3.5%. So is there even point looking at these savings? So potentially, if you've decided, you know what, I've sorted out my debts, I've got a good emergency fund, I'm able to cover all my payments, I've been able to, remortgage on a better deal from a variable to fixed to save money. I've moved my loans from balance to balance transfer so I could take them out, and I've got some excess capital. maybe it's time to start investing. And I will do another video about what kind of investments, because the stock market has been a bit crazy this year. But at a basic level, if you've looked at your debts and you think, you know what, this potentially is a good time to, I've got some excess capital, I can cover my debts, and I don't want to stick my money in those savings account, getting nothing, and this bank ain't giving me nothing. Maybe it's a good time to start thinking about investing. And if you are going to start thinking about investing, first thing you should do, any account you open is a stocks and shares ISA. And what is a stocks and shares ISA? It's basically an account where you will get, we've discussed before, it's basically an account where you can put a certain amount in every year, which is the start of the tax year. It's at the moment it's 20,000, and anything in there will not be subject to tax. Another tax, there's always tax here. There's NI tax, income tax. We're getting this new health tax. There's also a thing called capital gain tax, if you didn't know. So when you sell an asset or property, you're going to get taxed on that as well. But if you have all your investments in this ISA, you'll not be subject to that tax. Obviously, for the retail person, up to 20,000 a year is good. So if you're a high sophisticated net worth investor and you're got 100,000, a million, then obviously this is not going to be a great account for you, and that's why you would hire wealth managers. But for, I think, most people that's going to be listening to this chat, this YouTube channel, if you're thinking about investing because you've had enough of this negative interest rate you're getting from your savings, the stocks and shares ISA. So in conclusion, rates are going up. Bank of England is first major economy to raise rates, and let's make it a New Year's resolution to organise our debts. Let's put it as one of your things to do. Use this time to kind of organise your debts. Get you can go on Google. There's so many things where you can calculate budget spreadsheets, debt spreadsheets. But let's organise it, because this is only, in my opinion, industry rates. This is only my opinion. It could be right or wrong, but at the end of the day, you know, you could listen to a guy on YouTube. This is my opinion. You could listen to these great economists that said inflation was only temporary, and they got it wrong. So really and truly, it's everybody has an opinion. So whether they've got PhD or whether I'm on YouTube PhD, it's just my opinion. And my opinion is that we're going to see further rate rises next year. And now is a time, particularly, to look into your debt and try and lock in some prices and make sure you're not quadruple stung, because you're going to get stung by inflation. These guys, I don't know where they get their petrol from, but or maybe they all got Teslas. I don't know, but my petrol is going up, my bills are going up, energy is going up, my food prices are going up. You rarely go to the shops these days, and you don't. I remember going to Tesco's and I used to see all these deals, these good deals. You don't see that no more now. I think you can only get a deal if you've got a club card, but before it was open to anybody. Now they want you to, they're enticing you to get a club card now. Even the cheap shops like the Aldis, the Lidls, and I'm not ashamed. I shop there. Food is good as other places. Maybe certain foods I might not. They don't really have a good vegan selection. For example, I like to, um, you know, not eat meat all the time. They don't really have that great selection, but maybe Sainsbury's better for that. But in terms of like everyday stuff, yeah, it might be fake brands like fake cornflakes, but it's just sugar at the end of the day. So one sugar is as good as another sugar. So, but even in those kind of places, you're seeing the prices increase, and obviously they're still going to be budget because the big shops are increasing. And like I said, we're getting an increase in tax, increase in bills, wages are not going up. And now you're going to be hit by interest rate increases, increasing your debt. So it's going to be next year. It's going to, and like I said, if you're in a job where your wage is going up above inflation, then it won't impact you as much. But me personally, I haven't seen that up unless you're leaving jobs. I don't think your employer is going to be paying you annually probably about 6% pay rise. Now, if you are getting that, then cool. But if you ain't getting an annual 6% pay rise, 6-7% pay rise, you're gonna lose. You're doing the same amount, but you're losing money. So this is the time to start thinking about these things. To make it a resolution. This is the money effect. Hope you've liked the video. Hope it's helped you. Please like and subscribe. And yeah, I would say let's go, but we've ended, so let's keep it going. Thank you.